Your mortgage is $1,800 a month. Your property tax is $1,600. Your insurance is $1,200. Your HOA is $400. And after 30 years of paying, after a third of your life spent working for a roof over your head, you still own nothing. Let that sit for a second. You do the math in your head. You paid the bank, you paid the county, you paid the insurance company, you paid the HOA, and the moment you stop paying any one of them, the house is gone. Not yours, never was. This is not a mortgage, this is a subscription, and the subscription has 10 tiers, 10 states, 10 different ways the American homeowner has been quietly converted into a tenant who also does the repairs. I am ReportSTATE. I have been sitting in county assessor offices for 6 months. I have been pulling millage rates from town clerks who looked at me like I was asking for nuclear codes. I have been reading HOA covenants that run longer than the Constitution. And what I found is not a housing market. What I found is a trap. 10 of them. In one state, the HOA can fine you $400 for painting your mailbox the wrong shade of beige. In another, the property tax on a median home doubled in 7 years, not by vote, not by law, but by assessment drift. And at number 1, there is a state where the average homeowner now pays more per month in insurance and association fees than they do in principal. Where a hurricane hits, insurance pays out 23 cents on the dollar, and FEMA fills in the rest if you qualify. Which you probably don't. Before we start, do me a favor. Hit subscribe. Not because the algorithm needs it, because the next trap might be the one you are already standing in, and you deserve a heads up before you sign another contract without reading the fine print. This channel exists because somebody has to read the fine print out loud. That is the whole job. Let me ask you something. Yes or no? Do you know what your property tax will be in 10 years? Do you know the millage rate on the parcel you live on right now? Do you know what your insurance premium was last year versus this year? Because I promise you, the people selling you the dream of home ownership do not want you to know. And the people collecting on the trap absolutely do not want you to do the math. So we are going to do the math. 10 states, count down from 10 to 1. Each one more brutal than the last. Each one with real numbers, real families, real monthly breakdowns. By the end of this video, you will look at the map of the United States differently. You will not see 50 states. You will see 50 tax jurisdictions, 50 insurance markets, 50 HOA regimes, and 10 of them are rigged. Let's break it down. Number 10, Texas, the state that does not need an income tax. Here is the Texas pitch. No state income tax, strong job market, warm weather, oil money. Come to Texas, they said. Keep what you earn, they said. And millions of Americans did exactly that. They packed up U-Hauls from California, from New York, from Illinois. They bought starter homes in Austin, Dallas, Houston, San Antonio. They felt like they had escaped. And then the first property tax bill arrived. Texas does not have an income tax. Texas has something worse. Texas has one of the highest effective property tax rates in the country. Average 1.9% of assessed home value. Some counties push past 2.2. On a median Austin home assessed at $480,000, that is $9,100 a year. $760 a month. Every month. Forever. Or until you move. Let me introduce you to Marcus Delgado, 38 years old, nurse anesthetist. Moved from San Diego to a suburb of Austin in 2021 because the California cost of living was eating him alive. Bought a 3-bedroom in Pflugerville for $390,000. Felt like he had won the lottery. Here is Marcus Delgado's monthly breakdown in 2026. Mortgage principal and interest, $2,200. Property tax, $740. homeowners insurance $190, HOA $95. Total $3,225 a month. Now here is what nobody told Marcus. Because Texas has no income tax, the state gets its revenue from property. And property assessments in Travis County have gone up 22% since he bought. His tax bill went from $6,200 to $9,200 in 4 years. Nobody voted on that. No law changed. The appraisal district just decided his house was worth more. That is the mechanism. A guy on the Austin subreddit wrote it better than I ever could. Quote, "I didn't move to Texas. I moved to a property tax colony with good barbecue." End quote. Picture this. It is April in Pflugerville. The sun is already too hot at 9 in the morning. Marcus opens the mailbox. There is a single envelope from the Travis Central Appraisal District. He does not need to open it to know his assessment went up again. The envelope is beige. The paper inside is white. The number is red, 3% higher than last year. He stands there on his driveway, the one he technically owns, and he thinks, if I stop paying this, in 3 months they take the house. No income tax, no relief, no limit on how high they can reassess me. That is the Texas trap. You escaped income tax. You walked into the property tax colony. And here is the grim part. If you think a 1.9% effective rate is bad, wait until you see number 9. Number 9. Illinois, the state where the tax bill arrives twice. Illinois is a different kind of trap. And I want to be careful here, because people love to blame Chicago for everything. The Illinois problem is not just Chicago. The Illinois problem is statewide, and it is structural. Illinois has the second highest effective property tax rate in the country, 2.27% of home value. On a median Illinois home of $260,000, that is $5,900 a year. But here is the mechanism that makes Illinois worse than Texas. In Illinois, the property tax bill arrives twice, once in June, once in September, 2 installments, each one a gut punch. And it is not just property tax. Illinois has pension liabilities so deep, so underfunded, so politically untouchable that every single homeowner in the state is quietly subsidizing a retirement system they will never benefit from. The state pension fund is short by more than $140 billion. Somebody has to pay. That somebody is you, through your house. Meet Janet Kowalski, 51 years old, high school Spanish teacher, lives in a ranch house in Evanston she inherited from her parents in 2014. Paid off, no mortgage. You would think she is safe. Here is Janet Kowalski's monthly breakdown. Mortgage, 0. Property tax, $1,050. Insurance, $140. Total, $1,190 a month. To live in the house her parents bought in 1973 for $32,000. Janet makes $58,000 a year teaching. After federal tax, state tax, retirement contribution, she takes home about $3,800 a month. More than a quarter of her take-home pay goes to the property tax on a house she owns outright. A house with no mortgage. A house that she did not even buy. She is not building equity. She is not paying down a loan. She is paying rent to Cook County. Forever. The day she stops, the day she loses the job, the day she gets sick, the day her pension adjusts, the house goes. A Reddit user in the r/Illinois thread wrote this, quote, "My grandma paid off her house in 1991. She died in 2019. My mom inherited it. My mom now pays $11,000 a year in property tax on a house that has been in the family for 40 years. We are renting from Cook County now." End quote. Picture this. It is a Tuesday evening in Evanston. Janet is at her kitchen table. The property tax bill is in front of her, the second installment, due in 30 days. She has $1,200 in her checking account. She needs $1,050 for the tax. She needs $140 for insurance. She needs the rest for groceries, gas. The dentist appointment she has been putting off for 8 months. She stares at the bill. She thinks about her mother. Her mother paid this house off in 2017. 6 years later, her mother died. Janet inherited a paid-off house and a perpetual tax obligation that she cannot escape without selling. That is not inheritance. That is a lease transfer. That is the Illinois trap. Pay off the mortgage. You still owe the county, forever. And if you think Illinois is brutal, wait until you see what a median property tax bill looks like in number 8. Number 8, New Jersey, the $9,500 floor. New Jersey does not have a property tax problem. New Jersey is a property tax problem. The median property tax bill in New Jersey is $9,500 a year. Median. That means half of homeowners pay more. Some pay way more. In towns like Tenafly, Millburn, Mountain Lakes, the average bill pushes past $18,000 a year. $1,500 a month in property tax alone. Before mortgage, before insurance, before heat. Why is New Jersey like this? Home rule. Every town in New Jersey runs its own school district. Every town has its own police. Every town has its own public works. Every town has its own administrative staff. New Jersey has 565 municipalities, each one a little fiefdom, each one funded almost entirely by property tax. Meet the Patel family, Raj Patel, Priya Patel. 2 kids in elementary school, moved from Queens to Edison Township in 2020 for the schools. Bought a split level built in 1968 for $615,000. They thought they were upgrading. Here is the Patel monthly breakdown. Mortgage principal and interest, $2,900. Property tax, $1,150. Insurance, $130. HOA, $0. No association in their neighborhood. Total housing cost, $4,180 a month. Before utilities, before anything else. Priya Patel makes $84,000 a year as a pharmacist. Raj makes $96,000 as a project manager. Combined gross income, $180,000. Sounds great, except after federal tax, state tax, FICA, retirement, they take home about $11,000 a month. Nearly 40% of their take-home goes to housing, and half of that housing cost is not even mortgage. It is property tax and insurance. And here is the cruelest part. The property tax has a cap in New Jersey, a 2% annual cap. Sounds good, right? Here is the mechanism nobody talks about. The cap is on the levy, not the rate. Translation, the town can still increase the assessed value of your house, and the total bill rises anyway. The Patels bought in 2020 at a tax bill of $12,900. 6 years later, $13,800. They did nothing. The house did nothing. The paperwork just kept adjusting. A New Jersey homeowner wrote this on a local forum. Quote, "In this state, you do not buy a house. You buy the right to receive a tax bill every February and every August for the rest of your life." End quote. Picture this, the Patel kitchen, Sunday morning. Raj is at the counter with a spreadsheet open on his laptop. Priya is making pancakes for the kids. Raj says, "Honey, if we want to take the kids to Orlando for spring break, we need to skip 1 month of the 529 college savings." Priya says, "Why?" Raj says, "Because the tax bill for August is due in 6 weeks. and we are $900 short. The kids are laughing in the living room. They do not know that the vacation is being negotiated against the cost of the roof over their heads. That is New Jersey. That is the New Jersey trap. Great schools, great proximity to Manhattan, great commute, and a tax bill that quietly eats the family budget for 40 years. And speaking of states that advertise one thing and deliver another, wait until you see number 7. Number 7, New Hampshire, the live free or pay state. New Hampshire's state motto is, live free or die. They put it on the license plates. They say it at town meetings. They mean it about income. New Hampshire has no state income tax, no general sales tax. The state feels, on paper, like a libertarian paradise. Then you buy a house. New Hampshire funds almost everything: schools, roads, fire departments, ambulance services, through local property tax. The statewide average effective property tax rate is 1.93%. In some towns, it crosses 2.5%. The mill rates are published in the town report every year, and some of them are terrifying. Take Claremont. Mill rate in 2026, $42 per thousand of assessed value. That means on a $200,000 home, the tax bill is $8,400 a year. $700 a month. On a modest ranch house, in a town where the median household income is $51,000 a year. Meet Thomas and Margaret Hensley, both retired. Him 69, former postal worker. Her 67, former nurse. They bought their Cape-style home in Claremont in 1987 for $58,000. Paid it off in 2004. Pension plus Social Security, about $4,200 a month combined. Their property tax in 2026, $7,800 a year. $650 a month. 15% of their fixed retirement income, on a house they paid off 22 years ago. Thomas did not vote for this, neither did Margaret. They voted against the school bond 3 times. The bond passed anyway. Their tax went up $800 that year. The school needed a new HVAC system. The town approved it. The Hensleys pay for it, forever. What nobody tells you about New Hampshire is this: when there is no income tax, the burden on property owners becomes absolute. Every school budget, every new fire truck, every municipal hire, it all flows through the mill rate. And the mill rate does not care if you are retired. The mill rate does not care if you are sick. The mill rate does not care if your house is paid off. A local wrote on a New Hampshire Reddit thread, quote, "Live free or die is the motto. Pay your property tax or lose the house is the reality." End quote. Picture this: a Sunday morning in October, Claremont. The leaves are turning. Thomas is at the kitchen table with a coffee that has gone cold. Margaret is on the phone with their daughter in Massachusetts. Their daughter is saying, "Mom, why don't you sell and move down here?" Margaret says, "We would lose the house. Your dad was born in that house. His father built the porch." Thomas hears her. He does not say anything. He just looks at the tax bill on the table and thinks about the school bond and the new police cruiser and the ambulance service upgrade, and how every one of those decisions, made at a town meeting he did not attend, is slowly squeezing him out of his own home. That is the New Hampshire trap. No income tax. Perfect if you do not own anything. The moment you own a house, you are the income tax. And if you think paying $700 a month on a paid-off house is rough, wait until you see what number 6 does with something called a car tax. Number 6. Connecticut. The car tax nobody warned you about. Connecticut is quietly one of the most expensive places to own property in the country. Average effective property tax rate, 2.14%. Median property tax bill, $6,100 a year. On the surface, that looks tame compared to New Jersey. Here is what makes Connecticut different. Connecticut has a car tax. Yes, a personal property tax on your vehicle, every year, based on the assessed value of the car multiplied by the municipal mill rate. Some towns hit 60 mills. That means a family with 2 cars worth a combined $40,000 pays an additional $2,400 a year, just for owning the cars, in the driveway, of the house they are already being taxed on. Meet David and Susan Reinhardt, both in their mid-40s, 2 teenagers, live in Bristol, bought a Colonial in 2019 for $340,000. Both work, him in insurance, her in hospital administration. Combined income, $165,000. Here is the Reinhardt monthly breakdown. Mortgage principal and interest, $2,100. Property tax, $520. Homeowners insurance, $140. Car tax, annualized, $200. Total, $2,960 a month. And that car tax line, nobody warned them. Nobody in the closing room mentioned it. They found out in July of year 1 when a bill arrived from the town of Bristol for their Honda Odyssey and their Toyota Corolla. Here is the mechanism Connecticut does not advertise. The mill rate is set by the town. The state lets the town decide. Hartford's mill rate is over 70. Waterbury, 60. Bridgeport, 43. Your tax bill depends entirely on which side of a town line your house sits on. 2 identical homes, 1 mile apart, can pay $4,000 different per year. It is not a property tax. It is a geographic lottery. A Connecticut resident on a regional subreddit wrote this, quote, "I moved from Simsbury to Hartford for a job. Same car, same value. My car tax went from $300 to $850. Nobody told me that line on the map was worth $500 a year." End quote. Picture this. It is late July in Bristol. The Reinhardt kids are at summer camp. David is at the kitchen counter with 2 bills in front of him. One for the minivan, one for the sedan. Total due in 30 days, $1,900. He did not budget for it. It was not in the mortgage statement. It was not in the closing documents. It is not escrowed. It is just a bill that appears every July for owning 2 cars in a town that needs money. He thinks, we live in a state where the car in my driveway is taxable property. The car, in the driveway, of the house that is also taxable property. And the house that is taxable property is also insured by a company that is raising rates every year. Everything I own is a subscription. That is the Connecticut trap. Property tax plus car tax plus rising insurance plus mill rate roulette, depending on which town you land in. And speaking of rising insurance, wait until you see what happened at number 5. Number 5, Louisiana, the insurance exodus. Louisiana is not on most lists of expensive places to own a home. The property tax rate is actually low, 0.55% effective. The median tax bill is about $1,100. So why is Louisiana number 5 on this countdown? Homeowners insurance, that is why. In 2021, Hurricane Ida hit Louisiana. The damage estimate, $75 billion. In the 2 years that followed, 12 homeowners insurance companies either went insolvent, pulled out of the state entirely, or stopped writing new policies. The private market collapsed. The state-backed insurer of last resort, Louisiana Citizens, became the only option for hundreds of thousands of homeowners. And Louisiana Citizens charges roughly double what a private insurer would. The average homeowner's insurance premium in Louisiana in 2026, $4,400 a year, $367 a month. On coastal parishes, it doubles to $8,000, $1,000 a month just for insurance. On top of mortgage, on top of property tax, on top of flood insurance, which is separate and mandatory and also rising. Meet Andre and Monique Thibodeau, both in their late 30s, 3 kids, live in Homer, Louisiana. Bought their house in 2019 for $190,000. Modest brick ranch, half an hour from the Gulf. Here is the Thibodeau monthly breakdown in 2026. Mortgage principal and interest, $920. Property tax, $100. Homeowners insurance, $580. Flood insurance, $240. Total, $1,840 a month. On a house they paid $190 for. The insurance line alone is more than the principal and interest. Here is the cruelest mechanism. Andre and Monique did everything right. They elevated the house. They installed storm shutters. They upgraded the roof to impact-rated shingles in 2022. Their insurance went up anyway, because it is not about their house. It is about the zip code. It is about the reinsurance market. It is about the global climate models that Wall Street uses to price risk. The Thibodeaus are not paying for their own risk. They are paying for the entire Gulf Coast's risk, spread across fewer and fewer customers because the insurers are leaving. A user on the Louisiana subreddit wrote this, quote, "I pay more in insurance than my grandpa paid for this whole house in 1978. Every year, every single year." End quote. Picture this, August, Homer. The humidity is absolute. Monique is folding laundry in the living room. Andre is on the porch, looking at a tropical system forming in the Gulf. Category 1, maybe 2, projected to track west. He is not worried about the house collapsing, he is worried about the insurance renewal in November. Because last year, after a storm that did not even hit them directly, his premium went up 18%. This year it will go up again. It always goes up. The math is simple. In 5 years at this rate, the insurance will cost more than the mortgage, and he will not be able to drop it. Because the bank requires it, and he will not be able to find a private insurer because they all left. He is trapped, not by the storm, but by the paperwork that comes after the storm. That is the Louisiana trap. The property tax is low, everything else is a slow drowning. And if you think insurance is the only mechanism quietly gutting homeowners, wait until you see what number 4 does with a 45-year-old law. Number 4, California, the Proposition 13 trap. California is backwards. Everybody thinks California is the most expensive place to own. In some ways it is. Median home price in coastal California, over $1 million. But California also has something called Proposition 13. Passed in 1978, it caps the annual increase in assessed property value at 2%, regardless of how much the actual market value rises. Sounds great, right? Here is the trap. It only applies to you if you bought a long time ago. If you bought your California home in 1992 for $200,000, your assessed value today, after 44 years of 2% annual caps, is roughly $480,000. Your property tax is based on that $480,000, but the actual market value of your house is $1.6 million. You are paying tax on a third of what your house is actually worth. Now imagine you are the young couple who buys that same house in 2026. You pay the $1.6 million. Your assessed value starts at $1.6 million. Your property tax is 3.5 times higher than your 70-year-old neighbor paying the same 1.1% rate. Same house, same street, same services, 3.5 times the tax. Meet Jessica Chen and Aaron Goldberg, both 32, no kids yet, both tech workers, moved from Seattle to Palo Alto in 2025 for a job at a biotech startup. bought a 2-bedroom ranch built in 1954, 1,200 square feet, for $1,600,000. Put 20% down, $320,000 deposit, wiped out their savings. Here is their monthly breakdown. Mortgage principal and interest at a 6.8% rate on a $1.28 million loan, $8,340. Property tax, $1,460. Insurance, $210. Total, $10,010 a month for a 1,200 square foot ranch. Their neighbor Joan, 71, widowed, retired librarian, lives in the identical house next door. Bought it in 1986 for $96,000. Her property tax in 2026, $2,100 a year, $175 a month. Jessica and Aaron pay 8.5 times what Joan pays. For the same house, same street, same trash pickup, same schools. California did not create a housing market. California created a 2-tier property tax caste system. The people who got in before the gate closed, they are safe. The people who buy now, they are the ones funding the whole system. And because older homeowners refuse to sell and trigger reassessment, the housing inventory is frozen. Young buyers compete for scraps. Prices stay high. The trap compounds. A Californian on Reddit wrote this, quote, "My boomer parents pay $1,900 a year in property tax. I pay $16,000 a year on the house 2 doors down. Same builder, same year. They lecture me about avocado toast." End quote. Picture this, Saturday morning in Palo Alto. Jessica is in the backyard with a coffee. Over the fence, Joan is watering her roses. Joan waves. Jessica waves back. They are neighbors. They are friendly. Joan has lived there for 40 years. Jessica has lived there for 8 months. They both pay property tax on identical houses. Joan pays $175 a month. Jessica pays $1,460. The fence between them is not a fence. The fence between them is 47 years of Prop 13, and Jessica is the one funding Joan's services while also paying her own, while also trying to save for a baby. That is California. That is the California trap. A law that was supposed to protect homeowners from runaway tax increases became a wealth transfer from young buyers to the boomers who bought in time. And speaking of systems that quietly tax the people who can least afford it, wait until you see number 3. Number 3. New York, the 3-layer tax cake. New York is special because in New York, you do not just pay property tax. You pay 3 layers of tax that interact with each other in ways nobody explains at closing. Layer 1, the property tax itself. New York City's effective rate looks low on paper, 0.8%. But the assessment methodology is so opaque that 2 identical brownstones on the same block can have wildly different tax bills, depending on when they last changed hands and how the Department of Finance decided to categorize them. Layer 2, the STAR program, school tax relief, a rebate system that is supposed to reduce your tax bill. In practice, it is a labyrinth of income limits, age thresholds, and registration deadlines that routinely leaves eligible homeowners paying full freight because they missed a form. Layer 3. For the million-plus New Yorkers who live in co-op or condo buildings, there is the monthly maintenance fee, which is not technically tax, but functionally it is because it pays the building's property tax, the staff, the reserves, the assessments. And the co-op board can raise it at will. Meet Daniel Rivera, 58 years old, lives in a 1-bedroom co-op on the Upper West Side. Bought it in 2006 for $510,000. Works as a freelance copy editor. Income fluctuates between $52,000 and $70,000 a year. Here is Daniel's monthly breakdown. Mortgage principal and interest, Paid off in 2022. 0. Maintenance fee to the co-op, $2,400. This includes his share of the building's property tax, the doorman, the super, the elevator maintenance, the reserve fund contribution, and a special assessment for facade repairs that started in 2023 and has 2 more years to run. $2,400 a month to live in a 1-bedroom he owns outright. Paid off, no mortgage. $24,000 last year, and he cannot negotiate it. The co-op board votes. Daniel gets a letter in December saying maintenance is going up 7%. Again, he pays, or he does not live there. And then there is the board itself. The co-op board can reject a buyer for any reason they feel like. They can demand that Daniel put 2 years of maintenance in an escrow account before he sublets. They can fine him for installing a washing machine without permission. They run a lifestyle parliament in the building lobby, and Daniel is subject to it, indefinitely, on a property he paid off 4 years ago. A New Yorker on the NYC subreddit wrote this, quote, "I own my co-op. The co-op owns me. The math is final." End quote. Picture this, December, Upper West Side. Daniel is at his small desk in the corner of the bedroom, freelance invoices open in one browser tab, the co-op annual budget email open in another. The maintenance is going up. The special assessment is extended by another year. The board has proposed a lobby renovation. He does the math. He earns $62,000 this year. After taxes, after health insurance he buys himself, because freelance, $43,000 net. $29,000 of that goes to his co-op, to live in the apartment he already owns. He is 60% of the way into the year, and he has already paid more to the board than he has paid himself. He is not a homeowner. He is a dues-paying member of an indoor club. That is the New York trap. Property tax plus star confusion, plus co-op or condo fees, plus a building board that operates like an HOA on steroids. And just when you think rural America is the escape, wait until you see number 2. Number 2, Nebraska. The rural tax that eats the farm. Here is the one that surprises people. Nebraska. Midwestern, affordable, nice, famously quiet. Not a place most coastal Americans associate with financial danger. Nebraska has the 7th highest effective property tax rate in the country, 1.63%. And here is what makes Nebraska different from everywhere else we have covered. Rural property tax, particularly on agricultural land and older farm homesteads, is often higher per dollar of value than urban property tax. Because in Nebraska, school district funding relies overwhelmingly on local property tax, and rural school districts have fewer taxpayers spreading the burden. Meet the Larsons. Gerald Larson, 64. Carol Larson, 62. Third-generation farmers outside of Norfolk, Nebraska. Operate a corn and soybean farm on 320 acres. Live in the original farmhouse Gerald's grandfather built in 1941. The house is assessed at $165,000. The agricultural land is assessed separately at approximately $2 million. Here is the annual breakdown for the Larsons. Property tax on the farmhouse and homestead parcel, $3,200. Property tax on the ag land, $31,000 a year. Total property tax, $34,200 annually. To live in the house Gerald's grandfather built and farm the land Gerald's father farmed. That works out to roughly $2,850 a month. The Larsons' net income from the farm in a decent year, about $94,000. More than a third of it goes to property tax. And property tax in Nebraska does not care whether the harvest was good, whether commodity prices cratered, whether the equipment broke down. Property tax arrives regardless, on time, in full. A Nebraska farmer on Ag Talk wrote this, quote, "I am not selling corn. I am selling corn to pay the school district. Whatever is left over, I get to keep for food and diesel." End quote. Picture this, February, Norfolk, Nebraska. It is 11 degrees outside. The fields are frozen under 6 inches of snow. Gerald is in the kitchen of the farmhouse his grandfather built, doing taxes at the same oak table his grandfather did taxes at. Carol is making coffee. Gerald flips through the parcel statements. 320 acres. Assessment up again this year. 8%. Nobody voted. Nobody asked. The county just decided the land was worth more because commodity values were strong 2 years ago, even though this year corn is trading 10% below break-even. Gerald thinks about the conversation he had with his son last month. His son is in Omaha. His son does not want the farm. His son saw the numbers. Gerald is the last Larson who will ever farm this ground. Not because the land is exhausted, because the property tax is. That is the Nebraska trap. The farm is a bank account the state draws from whether or not there is money in it. A 100-year family legacy evaporating not to drought, not to market, but to an assessment notice. And that, brutal as it is still only number 2. Because if Nebraska can eat a 100-year farm with a tax notice, then wait until you see what number 1 does with an entire coastline. Number 1 is a different category. Number 1 is a state where the insurance, the HOA, the climate, and the building code have converged into one single enormous trap. And millions of Americans are still moving there, right now, because they see the beach and they do not read the paperwork. Number 1, Florida, the state that pretends it still has homeowners. Florida, the Sunshine State, the no-income tax state, the retirement dream. The destination of every U-Haul that ever left New Jersey, New York, Illinois, and California. In 2023, Florida added more than 300,000 new residents, more than any other state, and Florida is, by every measurable metric, the most expensive place in America to actually keep a house right now. Let me give you the numbers. The average homeowner's insurance premium in Florida in 2026, $6,080 a year. That is $506 a month, more than 3 times the national average. In coastal counties, Lee, Collier, Miami-Dade, Broward, Monroe, it routinely crosses $9,000, $11,000, $14,000 a year. HOA fees in Florida are the highest in the nation. Average monthly HOA in a planned community, $420. In condominiums, especially after the Champlain Towers collapse in 2021 and the subsequent Surfside law, monthly fees have exploded because buildings are now required to fund reserves for structural inspections and repairs. Some older Florida condos have gone from a $300 a month HOA to an $1,100 a month HOA inside 3 years, plus special assessments that can run into the tens of thousands for a single owner. Property tax in Florida is not that bad on paper, 0.8% effective. There is a homestead exemption. There is Save Our Homes, which caps increases at 3% annually for primary residences. So property tax itself is not the problem. Everything around the property tax is the problem. Meet the Kowalczyks. Michael, 67, Teresa, 65. Both retired from public sector jobs in Buffalo. Sold their Buffalo house in 2021 for $320,000. Moved to a condo in Cape Coral for $310,000. Thought they were downsizing into paradise. Here is what the Kowalczyks pay per month in 2026. Mortgage, paid in cash at closing, 0. Property tax, $230. Homeowners insurance, the building's master policy plus the owner's interior policy, $620. HOA fee, $780. Special assessment for the building's structural reserve, 2-year pay schedule, $410. Flood insurance, $190. Total, $2,230 a month. To own a condo they paid for in cash, in full, 5 years ago. Their combined retirement income, pensions plus Social Security, $5,800 a month. 38% of their fixed retirement income goes to the condo they already own. And every line on that list goes up every year. Then, October 2024, Hurricane Helene hits. Cape Coral takes a surge. The Kowalczyk's condo building loses the ground floor amenities, the parking garage, and part of the roof. Total damage to the building, $11 million. The master insurance policy has a deductible structure that nobody explained at closing. Insurance pays out 23 cents on the dollar. The rest becomes a special assessment on every unit owner. Each unit in the Kowalczyk's building owes an additional $22,000, due within 90 days. Michael calls FEMA. FEMA tells him condo common areas are not covered by individual disaster aid. He calls his insurance company. They point at the master policy deductible. He calls the HOA. The HOA says the assessment is not optional. Pay or the HOA places a lien. Lien goes to foreclosure in 10 months. The Kowalczyks, retired, cash poor, on fixed income, now have to decide whether to drain their IRA to pay a special assessment on the condo they already own outright, or lose the condo they already own outright. A Floridian on the Florida subreddit wrote this, quote, "You do not own a home in Florida. You rent the privilege of standing next to the ocean from the insurance company. Miss one payment, they take the beach back." End quote. Picture this, late November in Cape Coral. The building's common areas are still under a tarp. Michael is at the small desk in the condo's second bedroom, the one that was supposed to be for the grandkids when they visit. Teresa is in the kitchen. On the desk, the special assessment notice, $22,000 due in 60 days. The insurance renewal, up another 11%. The HOA budget proposal, projecting another increase for next year. The property tax bill, which, thanks to Save Our Homes, is the smallest number on the pile. Michael does the math. If he pulls $22,000 from the IRA, he triggers a tax event that pushes him into the next bracket and costs him another $4,000 in taxes. If he takes out a HELOC, rates are 8% and he is 67, banks are reluctant. If he defaults, the HOA starts lien proceedings by spring. He sold a Buffalo house he owned for 30 years, moved 2,000 miles, paid cash for a condo, and 5 years later, a storm that did not even fully destroy the building is about to take it from him anyway. And Teresa is in the kitchen, humming along to the radio, because she does not know yet. He has not told her. He is going to tell her tonight. Callback. Remember Marcus in Texas, watching his property tax climb while the state told him he escaped income tax. Remember Janet in Illinois, paying Cook County to live in her dead mother's house. Remember the Patels in New Jersey, negotiating a family vacation against an August tax installment. Remember the Thibodeaus in Louisiana, waiting for the next insurance renewal letter like it was a verdict. Every one of those families thought they owned the house. Every one of them was paying a subscription. The Kowalczyks are just the purest form of the trap, because in Florida, the subscription has 4 simultaneous parties collecting, and any one of them can cancel your access. That is the Florida trap. No income tax, warm weather, and the entire state is quietly becoming uninsurable, one zip code at a time, while the HOA and the building code and the reserve requirements close in from the other direction. The ocean is not taking back Florida. The paperwork is. That is your number one. So here we are, 10 states, 10 traps. Texas and its property tax colony. Illinois and its pension subsidy you never signed up for. New Jersey and its $9,500 median bill. New Hampshire and its mill rate that does not care if you are retired. Connecticut and the car in the driveway that is also a tax event. Louisiana and the insurance companies running for the exit. California and the 47-year-old law that turned your neighbor into your landlord. New York and the co-op board that owns the apartment you thought you bought. Nebraska and the farm that is being slowly assessed out of the family. And Florida, where the ocean, the insurance market, the HOA, and the building code have formed a four-party collection agency against every retiree who ever bought a condo for the view. Now, do me a favor. If any of this hit, if you recognized your own monthly breakdown in any of those 10 stories, hit subscribe. Not for the algorithm, for yourself. Because I'm going to keep reading the fine print out loud every week for as long as they keep writing it. The next trap is already being drafted. The next assessment is already being mailed. The next HOA meeting is already on the calendar. And somebody has to sit in the back row and take notes. Remember what I said at the top of this video. Your mortgage is $1,800. Your property tax is $1,600. Your insurance is $1,200. Your HOA is $400. And after 30 years, you still own nothing. You never did. The paperwork owned you the entire time. The house was just the hostage. That is the end of The Trap. 9 episodes on the systems that quietly empty your wallet. Next block is the creepy, the America that does not show up in your feed. The abandoned towns, the silent infrastructure, the places where something went wrong and nobody reported it. If you thought the financial traps were unsettling, wait until you see what is waiting in the zip codes nobody talks about. I am ReportSTATE. Keep reading the fine print, because nobody else will.